welcome to our 2024 investor presentation. It's great to see so many of you here today. This is a bit of an experiment for us because we actually ran another event last night. That was a sellout event. So I think over the course of these 2 days, we've been in front of something like 500 or well over 500 of our investors. So it's great to see you here. As Michael said, these meetings are really important to us, and we know that they're very important to you. And it's a chance to talk face to face, which is something that is easily missed in an increasingly technology-driven world. And we know it's a point of difference for us. Our customers, both our borrowers and our investors, tell us time and again this is why they choose us over others in the market. Our business is about people first, and as we evolve, that won't be changing. So today I'm going to provide an overview of how we've performed over the last year in what has been a pretty challenging economic environment. I'll also discuss our plans going forward. As Michael alluded to, we'll allow time for questions at the end of my presentation. If we run out of time or we don't want to ask a question publicly, please feel free to come up to myself, Michael, or one of the team afterwards. And please note today that my presentation I'm not providing financial advice, I'm providing factual information only. So it's a real pleasure to host our investor meetings here in Tauranga. As Michael has alluded to, we've been on a bit of a tour around the country, and we're winding up and here with pretty much 3 sold out shows, much the same as Coldplay. Unfortunately, the front man's not quite as exciting though. But yeah, Tauranga is a region that's very close to our hearts. It's our home to our head office. It's where 38 of our team are based, and it's a community that we're really proud to support through various sponsorships and initiatives. This is the second of our two events, and we have over 4,000 investors located in this region. So, it's great to see a lot of familiar faces here again today. We're incredibly proud of our long-standing connection with the Tauranga community. Some of you have been with us since we first opened our doors nearly 30 years ago, and your continued support is really means something to us, so thank you. And thank you for trusting us with your investments and for being such an important part of our journey. So now let's take a look at how the fund has performed over the last 12 months. As I mentioned, it's been a tough economic environment, and I think it's fair to say that the Reserve Bank have achieved their goal of taking the heat out of the economy, and Tony will definitely have something to say about that in his presentation. We're really pleased with how the fund has performed, particularly the strength of our loan book, and this highlights our active and disciplined approach we take to managing your money. In the last year, we originated just on $1 billion of loans, and our loan book today now stands at $1.45 billion. It's spread across 620 loans and is secured by nearly 1,600 first mortgage properties. So this means that on average, every loan that we do is secured by up to 3 properties, and this helps to contribute to our very low loan-to-value ratio of 46%, and this is well below the maximum levels permitted under our governing documents. In addition, our loan book remains well diversified across various asset types and geographical locations. However, the results that really matter are the measures of how our loan book has performed. And for those of you that have attended our meetings before, you'll know that one of my favourite sayings is lending the money is the easy bit, it's getting the back that takes the skill, and that's what we focus very heavily on. So on any number of measures, we've performed to a very high standard. As at the end of October, our non-performing loans sat at 0.53%. Now, for context, the range across the 4 major banks is between 0.4 and 0.8%. So we're at the lower end of this range. Since this date, we have had one borrower that's transitioned into what we would call a non-performing loan, and this has temporarily pushed us over this level, although we believe that this will be remedied shortly. We're very well secured and we won't be making any specific provisions on that. Smaller registered banks, by comparison, have non-performing loan rates at between 3.5% to 4%, and we're still sitting well below those levels. As you'd expect in the tough environment, it hasn't all been plain sailing, and we did experience an uptick in our 30-day loan arrears, though these have remained at very low levels when compared to our historical performance and others in the lending industry. Pleasingly, very few of these transitioned into 30-day plus arrears, which speaks to our conservative approach and our great work from our team. Over the last 12 months, we were required to undertake 4 mortgagee sales, and whilst this is something that we don't enjoy doing, protecting our investor capital is our number one priority, so we won't shy away from having the difficult conversations when they're required. Something you may not be aware of is that we maintain a reserve fund which is designed to cover any potential loan losses. The fund grows by retaining 0.175% of the return that we generate. And so the return that you receive each quarter is net of this contribution. Over the last year, the reserve fund grew to $14.5 million. We had only one instance where the reserve fund was utilised, and this was for an amount of $135,000. So if you put that in the context of a $1.45 billion loan book, it's pretty small. Currently, the reserve fund now grows at around $750,000 per quarter, providing an additional buffer over and above our already prudent loan origination standards. As I mentioned earlier, we're incredibly proud of these results, which are a combination of our highly skilled team and our very clear understanding of our driving principle, which is optimizing investor return as opposed to maximizing it. Our primary goal remains to protect investor capital while delivering a stable return, and we've continued to meet this objective in the past year. We say no to the majority of the lending transactions that come across our lenders' desks as they don't meet our target market or our risk appetite. And we're very unapologetic in our strategy to say that we're going after bank market share by providing the level of service that they are unable to provide. And we now find ourselves in the position that we're no longer getting to look at transactions after the banks have said no. We're actually competing head-to-head with them. And for those of you that read our June newsletter, you may recall an article about the changing landscape of funding in New Zealand and how this trend is mirroring what's happening overseas. The global non-bank or private credit sector, as it's becoming commonly known, continues to grow and now accounts for roughly half of the global financial system, according to the IMF. It's recognised as being systemically important, not just to its size, but also to the competition that it's providing to the banking sector. New Zealand is only just getting started when compared to other countries, and we have enormous growth potential here. We're about 8% of the market. Australia is about 25%, forecast to grow to 40%, and in America it's 50%. So as you can see, we really are only just starting. And you may have heard about the recent Commerce Commission report into banking services, and this report highlighted the need for greater competition in the lending sector. We know the customers want this, and we now know the regulators are encouraging it, and we're very well placed to take advantage of these opportunities. Internally, we don't like to use the term non-bank lender because we believe it devalues our service proposition. We also wouldn't want to be considered to be a bank because of the negative connotations that come with this as well. You may have noticed in some recent media engagement, we have been using the term private credit, as this is a term that's widely internationally used and is being increasingly adopted in New Zealand. However, we understand the need for regulators to be able to put lenders into buckets. You're either a bank in their eyes or you're not. And in using these terms, they don't distinguish between the different service providers and risk propositions. We'll let others put labels on our sector and just focus on being New Zealand's best first mortgage lender. So that covers the lending side of the business. In terms of how the fund has performed, we're pleased to say that the fund now sits at $1.75 billion. In fact, we're closing in on $1.8 billion. And we've grown by over $100 million in the last 12 months. We now have 6,700 investors, and this is up from 6,400 a year ago. And this really highlights investor support in us in what has been a difficult period. We're very proud to have increased the investor return from 7.02% 12 months ago to 7.44% in September. Now, unsurprisingly, we do believe we've reached the peak of our return for the risk that we're prepared to take. So we are anticipating a reduction in our December return. However, we will still continue to offer a significant premium over the bank term deposit rates. As you can see from the graph, the difference between our rates in green and the main banks continues to widen, and you can really see the drop-off over the last couple of months in the bank 12-month term deposit rates. On average, a 12-month term deposit in September 2023 would have produced a return of 5.98%. An investment into FMT over the same period would have produced a return of 7.39%, and if the quarterly distribution was reinvested, that grows to 7.59%. In dollar terms, we distributed over $120 million in the last year. We've grown our reserve fund to $14.5 million and delivered a loan book performance akin to the four main banks. The interest rates that we charge our borrowers also aren't linked to any benchmarks such as the OCR. So we use our judgment on where we see market pricing relative to the risk that we're prepared to take. And because we aren't linked to the OCR or some other benchmark, when they fall, we don't necessarily have to lower our rates as well. And whilst the interest rate trend is downward, we anticipate that we'll be able to keep our returns higher for longer, certainly when compared to term deposits. In terms of the manager, we've continued to invest very heavily into the management of First Mortgage Trust. We're now a team of 68, having added 9 people in very recently. This is growth of 15% at a time when other businesses are contracting. And over the last 2 years, we've actually grown our team by over 30%. We've expanded our presence by opening a new office in Wellington, and we've secured Phil Bennett, who Michael mentioned before, to lead this office, along with another highly experienced property finance lender. Our growth isn't just about adding people either, it's about the new roles that we've created and the caliber of people that we've brought into our business. We've introduced 2 key positions to our senior leadership team, one to lead our investment offering and a chief technology officer to drive our technology initiatives. And we have Matt Tucker, our chief technology officer, here today. Technology is a key foundation of our strategic plan, both from a cybersecurity standpoint, but also about enhancing our customer experience. We aim to balance providing our customers with enhanced technology whilst maintaining the personal touch. And that's something that is very important to us, because we also know that we've got some customers who don't want to engage with us with technology, and we're committed to supporting them with the same exceptional FMT service that they've come to expect. We're currently developing an investor portal, and we'll share more information about this in our next newsletter. And in the new year, we'll provide more details as we approach the go live date. Initially, the portal will allow users to create accounts online, view their account details, and make basic edits to their information. Over time, we plan to add more functionality with a goal of offering more self-service options, but only for those that choose to use it. Cybersecurity is top of mind for us, as we consider it's our biggest operational risk. Our approach is grounded in strong governance, prevention, detection, and response. We are committed to aligning with industry best practice to ensure that cybersecurity remains a priority, managed comprehensively embedded through our FMT. We invest into advanced technologies, including AI, to prevent breaches, and we partner with leading cybersecurity firms for independent oversight. Our systems are monitored around the clock, utilising real-time threat intelligence from government and private sector sources to swiftly identify and address any vulnerabilities. Our commitment to cybersecurity extends across our entire organisation, from our team right through to our board, who receives regular updates on cyber risk, along with ongoing awareness training, which is crucial to maintaining a strong defence. Given the constantly evolving nature of cybersecurity, we've established a specialist technology team dedicated to this critical area. It's not just about people and systems we're investing into. We've also launched our wholesale fund, which is open now to eligible investors. This is a fixed-term product, and it'll benefit all investors as it'll enable us to lend for a longer term, which is a market that we haven't previously targeted, and it'll also enable us to hold lower liquidity, which will enhance return for all investors. We also continue to work very closely with our regulators, being the Financial Markets Authority or the FMA, the Reserve Bank of New Zealand, and at a more operational level, our supervisors, trustees, executors, and public trust. And as many of you know, it's this supervisory oversight that sets us apart from others in the market. With the growth in the non-bank sector globally, there's an increased regulatory focus, and we embrace that. In the last 12 months, we've completed liquidity risk management, value for money, and cybersecurity reviews for our regulators. We have recently received feedback from our supervisors, trustees, executors on our value for money proposition. They have deemed that we clearly provide value for money for our investors, and they consider the quality of our submission to be outstanding when compared to other fund managers. Being actively involved in our communities is also very important to us. We partner with various organisations, clubs and charities, with Save the Kiwi being our most prominent. And we do this on behalf of our investors, but not at their expense. So looking towards the next 12 months, we continue to look forward with confidence despite the economic headwinds. This confidence is driven off the back of the structural shift continuing to gather momentum in New Zealand, which is now being supported at a political and regulatory level. We have demonstrated our ability to consistently perform in a challenging environment. It's been a tough 2 years for the New Zealand economy, and we've met our objectives of protecting investor capital and providing a stable return. Tony will discuss the economic environment, but we think falling interest rates are a positive step for our sector. This in time will create greater confidence and lead to further opportunities. However, as I mentioned, our greatest opportunity is continuing to take back market share as is happening overseas. The issues the New Zealand banks are facing are mirroring their overseas counterparts. They're capital constrained in real estate lending, their appetite is limited to very vanilla transactions only, and they're losing their capability, which is impacting on their customer experience. We're well placed to take advantage of the opportunities that this presents. We also continue to invest into the management of FMT to ensure that we provide the best customer service possible. So in summary, we've performed really well in challenging conditions. We have a clear understanding of our value proposition and how we bring this to life. We're an active manager who continues to invest very heavily into the management of First Mortgage Trust. We have an investor-first mentality and can proudly say that in 28 years, we haven't lost a cent of investor capital, nor have we missed a quarterly distribution. And whilst there's economic headwinds, we expect the property market is going to continue to improve, and we have a positive outlook going into 2025. That concludes our formalities. I'd just like to say thank you very much again for attending and your continued support. So please join us for a cup of tea and a sausage roll. Thanks very much.